As we're seeing this sell-off in the tech sector, we want to welcome in Ed Yardeni, president of Yardeni Research. Dr. Ed, always great to have you on the show. So
Thank you.
you heard the two of us talking there. Interesting moves today, Ed. You know, NASDAQ is slipping. Lots of attention from investors on the chips, of course, moving on those headlines. Let's start there, Ed. What do you make of the market action you're seeing in today's trade?
Well, I think that it's a lot of confusion, quite honestly, on a day-to-day basis. There's a lot of confusion about whether this is it. This is the great rotation into SMID caps, or whether this is just a short covering rally by a bunch of hedge funds that were short the SMID caps and long the mega caps. There's a lot of confusion about what the economy is doing, and the economy looked pretty good on today's economic indicators. The housing market looks like it's bottoming, and industrial production was relatively strong, which kind of makes you want to scratch your head and say, well, so why is the Fed lowering interest rates exactly? So it's a lot of cross currents here, but I think the Fed is pretty much locked into lowering the Fed funds rate in September by 25 basis points. They've made it pretty clear that's what they want to do. The inflation rate is definitely going to go in the right direction in that case. And I think we're in what I would describe as a broadening melt up in the market. It had been very focused on the mega cap, and now I think it's spreading to the rest of the market. And I particularly like the S&P 493, all the stocks except the mega cap 7.
And so, to your point, how do we know if this is going to last, or do we just wait? Or are there things that you can kind of look at that'll help you signal that?
Well, first and foremost is, what is the economy doing? If it is heading into a recession, then we don't want to be in any highly exposed, economically sensitive areas of the economy with high valuation multiples. But I don't think the economy is heading into recession. There's still people, I call them the die-hard hardlanders. They just convinced that we're going to get a hard landing here. I think they've been proven wrong for the past couple of years, and they're wrong again. So I don't think we have to worry about a bear market. And so what we have to worry about is, what sectors do we want to be in? And I think for the long haul, you want to stay with technology for sure. I think communication services also are an area where you want to be involved. I think some of it is AI related. Some of it is simply that technology companies can solve a very important problem we have, which is a shortage of skilled workers. I think you want to be in the industrials, particularly as a result of onshoring. And I like financials as the yield curve disinverts, if you will.
And Ed, quickly, you did mention small caps. I do want to get your take just to drill down a bit more into that, because, listen, it's been such a subject of conversation for investors.
Yeah.
The move there, Ed, just quick and aggressive. You see them pulling back today a bit, although, you look at the Russell in 2000, I mean, it's down less than the SPX. But your thoughts on the small caps, Ed? When you're talking to clients, what do you tell them?
Well, the thing that's been discouraging about the small caps is how poorly they've been performing all along here until the past week. And so that kind of raises the legitimacy of this rally. It may very well be related to just simply that the market expects the Fed will cut rates, and smaller cap, mid cap companies will benefit more from lower rates. But when you put a microscope to it, you'll see that the big moves have been in biotech, and also in banking, regional banks, small regional banks. And a lot of that could just be simply short covering. I don't know that their fundamentals have radically changed. So I'd be a little wary of of chasing the SMID caps, the Russell 2000, but I think the market is broadening within the S&P 500.
Ed, I want to ask about fixed income and what we're seeing in the rates market right now, too, because, of course, we've seen the 10-year yields come down with this expectation the Fed's getting closer to cutting here. What are you watching for in that market? And do you think that right now the market's sort of adequately reflecting the outlook for the Fed on that side of the equation?
Well, I think from what I understand, that the market indicators are showing is there's a 100% probability that the Fed will cut the Fed funds rate by 25 basis points in September. So I got to believe that that's in the bond market, that's in the stock market, that's anticipated. And I think, when you look further out over the next 12 months, the federal funds futures markets are basically anticipating 5 rate cuts over the next 12 months. Now, the futures markets have been wrong before; they could be wrong again. I do think there's going to be a September cut, but I'm not quite convinced that there's going to be a lot more cuts after that. And I think the bond market's also somewhat skeptical. And the bond market, meanwhile, has to deal with supply. There's a lot of bonds and notes that the Treasury is going to be issuing. So I'm looking at a 4 to 5% wide trading range for the bond market. I don't think we're going to drop under 4%, but there are people who are convinced that's about to happen.
And Ed, when you say you'd be looking for a cut in September, but not many more after that, how come, Ed?
Well, look, past couple of years, a lot of people were looking for a recession. I wasn't there. I didn't anticipate that there would be a recession, and it's the same story now. The economy looks like it's pretty resilient. Looks like, the Atlanta Fed's GDP now was just revised to show an increase of 2.7%. It's been, that's up from 1.5% a few weeks ago. So the economy is looking pretty good, and meanwhile, inflation's going in the right direction. So what's the rush to lower interest rates? I thought the Fed's game plan until recently was to wait until inflation actually does get down to 2% and stays there for a few months. And now they seem to be changing the rules and saying, well, we're almost there. That's getting close enough. So if we continue to move closer to it, we'll go down to 2%. I can't ignore what they're saying. They're in charge, not me. I'm concerned that if they lower rates when it's not really necessary, we'll get a melt up in the market. And the problem with melt ups is they tend to be followed by meltdowns.
Although we've seen a pretty good melt up thus far this year, I don't know. Is this the meltdown that we're now seeing?
No, I don't think so.
All right.
No, I think there could be more to the melt up, quite honestly.
All right. We will check in with you soon again and talk about it. Thanks so much, Ed. Appreciate it.
Thank you.